Stocks broke through support today, and that has an impact on the market forecast and posture going forward and what expectations we have going forward. We're going to take a look at how bearish this support break was, what it looked like across the different major indexes, what other technical indicators are saying in terms of how bearish we should be right now. And we take a look at what the stock that drove a lot of today's price action to see some interesting technical patterns on that stock with some opportunities, some pretty decent opportunities for some trades. And that's where today's trade idea goes. So let's go ahead and get started. Today is Monday, March the 19th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching today. Welcome to those that are watching for the very first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking that red subscribe button right down below the video. You can do that right now while you're watching. Also, while you're down there, click that thumbs up icon. That lets us know that you like today's video and you want us to do it again tomorrow. One click, really easy way to give us feedback there. Let us know whether you think we should keep doing these. Comment on anything that stood out to you from today's video. You can scroll down further and see the comment section down below. Finally, join our daily email list. There's a link that I've highlighted in the description, video description, where you can join our list. I send out emails every day to let you know when these videos are posted, to let you know what we talked about, hyperlinks, timestamp summaries of what we talk about, as well as a list of all the overbought and oversold clusters using the market forecast and all the stocks in the S&P 500. So to get that, make sure you sign up for that list. Follow me on Twitter for more content in addition to these videos throughout the day. You can see my handle on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Finally, join the Market Outlook community on Facebook. Again, see the address up there at the top. You can also see I've highlighted a link that will take you there down in the video description below. All right, well, let's take a look at the S&P 500 first then with the market forecast indicator. Interestingly enough, as bad as today was in breaking through 2750, and that was that support that we talked about on Friday that would change things. And of course, it did change things. We have intermediate posture now that's down below the reversal zone here, or not reversal zone, that's dropping down, showing a bearish posture now. But what you also notice is that despite the down day, short-term sentiment actually improved. They both went up from where they were, which is interesting. And the reason why is because we got something today that we haven't gotten the last few days, and that is a long lower shadow. And interestingly enough, you notice drawing the lines across the bodies here that we did dip down. We dipped down below the 62% Fibonacci retracement of this near-term rally. But by the end of the day, closing off of the lows about, what, 18 points, 94 to 13, 17 points or so, or 19 points, if I do the math right. You know, it jumped up. So not as well. And there's some support here from this level that so far is holding. And then, of course, producing. Now, again, falling market sentiment means path of least resistance to the downside. We've talked about that before. It continues down. The intermediate posture now is bearish. It's not strongly bearish because you're almost like backed up against the end zone here. It's a touchback. The Bears got a touchback and they're back out on the 25-yard line. The Bears have the ball, or 20-yard line if it was a punt, I guess. But you can see short-term sentiment improving, and if it does keeps improving, this support holds, and we hold in this Fibonacci retracement area here. Then now, granted, the odds of a new near-term high have gotten that much lower because we broke through the 50% Fibonacci retracement. We broke through that support there. So the odds of a new strong bounce are down. Doesn't mean that we can't break up to a new all-time high, but not as high of not as good as a chance as we've had before if we would have bounced off of here where we were coming off the 38% Fibonacci retracement. So now I actually got to move this down. We are now, what, here, 1, 2, 3, 4 days. So we're a little long now in this bearish move. And of course, while the momentum line didn't get to an extreme low, the near-term line did get into the reversal zone. So, a little bit of a bearish posture. Of course, a lot of this is Facebook news. We'll talk about this more here in a minute. This short-term break produced this bearish posture, but it wasn't it didn't break enough. You see, it got down to 30, even got down to the 30-day moving average here, and wasn't able to really close significantly below it either after trading down below that. So you can see it seems like the bears are trying to get something going, and of course they've got the momentum on their side from a long-term basis because market sentiment's falling, but they're not able to really keep things down and keep things pinned down. What they are able to do is keep things from really going up, and again, that's what happens when market sentiment's been high and we start to fall. It seems like it's really hard to get going up, but even then, during this time that market sentiment's been falling, we've continued to be on an upward trend. We just have had bigger near-term pullbacks than what we're used to, because in the past, near-term pullbacks were very minuscule. And so, we're just getting, again, with the VIX as high as it is, we're getting more volatility than what we've come accustomed to, especially in 2017. We take a look at the Dow Jones Industrial Average here. You can see it did break and close below the 62% Fibonacci retracement. Not as bullish of a move, still long lower shadow there. And you can see its posture is more bearish because the intermediate line is below 50. But you also see since the middle of February, we've been kind of fluctuating. And I mentioned before, too, that we've been kind of coiling. And it looks like, as of right now, that we're breaking this coil. If I were to come across these lows, that we're breaking this coil to the downside. So right there, just like that. So coming off these candle lows here, breaking it to the downside. So a little bit of a bearish sign there. Then you look at the NASDAQ Composite, which has been the big winner, right? The big leader. Well, we busted through 7,500, which is that old high. We busted through 7,400, which is this old high. We came down. So we're still not forming lower lows, and we're still right around the 50% retracement of the near-term run. That shows how strong that near-term rally was to new highs, and it still would be a higher low point, and because of the long lower shadow, we still have an improved short-term sentiment, and market sentiment still strongly bullish. So yeah, it's we're getting deeper near-term drops because of the higher volatility that we're getting in the market. And then finally, the Russell 2000 again. I mean, look at its near-term line. Look at that long lower shadow, even stronger, and holding that old low point that the NASDAQ didn't, or that old high point for support. 1550 is the area, so we didn't break below that. Long lower shadow and a much more improved near-term sentiment. So Russell 2000 showing some relative strength, which is a good sign for stocks. And it's hard to be too bearish. Doesn't mean that we can't be bearish, because the posture is bearish for the Dow or the S&P, and it's even more strongly bearish for the Dow. But keep in mind, the Dow has been fluctuating around 50. Hasn't really significantly moved one way or the other yet to break out of that coil that we're seeing on its channel. And everything else off of that low point in February, despite the ups and the downs, continues to show bullish trends. This should also put the this downward move in context. As you can see, we're fluctuating around the 50-day moving average, and we've pulled back down below 2750. So breaking that support shows a new weak bearish posture. That's what the Dow, the S&P, the Dow looks very similar. You can see it's still kind of coiling even on a long-term basis there, following momentum, which means that MACD and stochastic the long-term moving average are closing towards each other. We're going to get a lot of arrows like we've seen before. But then you look at like the NASDAQ Composite, and we're still easily above the 50-day moving average. You still haven't really got that confluence of arrows yet, because the MACD really hasn't started to fall yet. And then finally the Russell 2000, which has been more bearish, right? Previously had been more bearish. You can see it's popped back up above the 50, and this little pullback we're having is still easily above its 50-day moving average. So you can kind of see now, short-term, MACD is falling, but we've seen this before, and it produces arrows when it's falling, but then you can see we rallied up to new highs. And so are we in this kind of mode right now? Remember, seasonality-wise, March and April tend to be pretty bullish months, until we get to the spring. And the spring is when we start to get some volatility again from a seasonal basis. So we'll see if we fluctuate around these rising moving averages for a while until in the spring, where more likely we are likely from a technical perspective, from a seasonal perspective, more likely to get below that 50 and maybe start to push towards the 200 again, like we've seen before. The 3 green arrows, we're back to 3 red arrows, just like that. So we dropped below, barely closing below the moving average, easily below the 8 and the 17. The 8 and the 17 is still, the 8's still above the 17. That's why the MACD is above 0, but you see crossing below its moving average. Stochastics had already crossed below its moving average, following through with that. If this support doesn't hold here, the moving average and this upward trending line, then there's the possibility of being more bearish here for a while. Right now we're kind of at that point where we can still hold and bounce off a higher low point and continue with this volatility up and down, or we break through and we have the chance of being more bearish here for a while from a technical perspective. All right, when you take a look at the intraday chart, you can see we gapped right below last week's low point. We're missing the intraday data from Friday, but remember Friday was a very small trading range, the smallest that we had. And then boom, we popped open here with a 4.5 point range. Lots of volume here coming throughout the day. And you can see, a little bit of a double bottom at the end at 269. We bounce back up. And there's, we've had some lows here. Let's go out to the 4-week range. Brief little low point there. Not much of a support. So I wouldn't say that, we bounced off that support at 269. But, we continue. You notice what we did is we broke through. So once we got about to this point here in the morning, and this drop right there, we broke through the halfway point of the 4-week range. So now you notice, we're not plummeting, right? Well, things will get more bearish when you break through 264, right? So we're not plummeting here, but now we are in the lower half of the range. So that gives us a little bit of a bearish bias. Remember, the posture is weakly bearish now with the S&P rolling over. If we were to hold this support that's on the S&P and bounce up through and maintain a bullish move, a bullish low point here, even if we don't break up to new highs, but if we're going to break up into the upper half of the chart, 271.5 is a key level that we want to watch for and see. If we break above that, great. If we kind of peak around 271, 271.5 and push down lower into this area, then we know we're probably going to be in the lower half of this 4-week range for a while. We won't, it doesn't mean we have to bust through and things are going to be, things are going to be helter skelter. But it will mean, we've lost that bullish momentum that you have when you're trading in the upper half of the 4-week range. Now looking at, you can see the volume, the volume was strong, wasn't as strong as you'd expect for a 4.5, actually for a 5. And really, you have to look at the range here. I guess I couldn't do the math right. When you look at the range, you have to take into account the gap. So the low at 270, the close at 274.20, the high at 274.40. Okay, so we filled in that high, but then with the low point today, the range, the R, 5.78. So that's almost 6 points of a range. And then you look at, where are we at here? You look at the range here. 6, that's way up above the upper end. The upper end's at 4 3/4 of the 52-week range. The average ATR, almost 6 points, is way up there. And then you look at the volume, it wasn't way up there either. So, it was actually kind of right at the average, which is in the lower half of the range. So again, and another sign that maybe things aren't so bad, we've seen when you start to really break through levels, the range and the volume will both get extremely high, in this upper area here for lower end. So, we're already pretty high, and still, despite today's move, the ATR bouncing up a little bit here, but not, you can see we've had a couple other days where it bounced up. We're still, for the most part, trending lower on both of these. If this support holds, that will continue to be the case. If we break below that, we'll start to trade in the lower half of this range, 4-week range, with some more volume most likely, and start to push this up higher again. Again, this for some context on that ATR looks really high. You can see for the most part it is pretty high relative to where we've been for a lot of this time frame. Last time we were, let's go back even further The last time we were up this level on an average basis was 2009 when things were really hitting the fan. So that kind of shows you, just how moderate things have been. And really in 2017, look at that. But all the other times we get to these levels, we pull back down for a while, and even before 2008. So we got some, there's some pretty good volatility here. It seems like things are crazier than normal. Well, this should give you that perspective. From a volume basis, you notice we're not anywhere close to that volume that we were getting, even in late 2007, early 2008. And of course, things change and ETFs change. But even compared to 2015 and 2016, the last time that we were testing and breaking and holding below the 200-day moving average, our volume's not even close to those levels on an average basis yet. We take a look at the VIX. We do have this. Again, we're missing that intraday data here, but the low points there now, which ends up being a slightly higher low point of volatility. Now the question is, now that we're popped back up here, are we going to get a higher? Are we going to kind of break out of this range and get back up to 20, 25, and 30? And I've shown you before when we've gotten up to 40 on the VIX. Here in this area right here, last time we got up to 40, we came down and held this 15 area for some support, similar to what we're doing now. And then we kind of had a couple ups and downs where we did peak up to 20, peaked up to 22.5 and came back down to this 15 area before making a run, a more sustained run in that 22 to 27.5. So we might be, at the end of 2015 when we were doing that. Here, let's go back to the S&P and look at a longer term basis here, what things look like back here. You can see at the end of 2015, we trended up higher while the VIX was making a couple of runs. Every time it dropped, the VIX made a run up to 20, 25 before making a more sustained run there. So if this is how we finish out March and April before May and June hit something like this, we've seen a precedent for that before. And that's on a real-time basis. On an absolute basis, that's on an absolute basis. On a relative basis here, as bearish as it was today, the volatility is still below 1. It closed the day below 1. So if we were to close above 1, then we could be bearish for a while. And you can see we've seen that before. Volatility can get big, and we can take advantage of that because you see how it slowly works its way back down. So we're not quite breaking out yet in those long upper shadows. Every time we get these long upper shadows, the volatility has come down from, after that. And we'll see if that ends up being the case again today. All right, now let's transition into what's driving this price action today. And really quickly, I wanted to bring up, some of you might be watching this, might have gone here, the link that was on Twitter or in the email that got sent to you might have pushed you to our blog. And push you to this site. And of course, you can always subscribe to our blog by coming up to the top right corner here and clicking on that subscribe button. That will subscribe you to be able to see other posts that we put out here. But you can also see here, of course, you're probably watching the video here by clicking on that play button. But you can also have the ability to really easily like both the Twitter, the tweet for today, even if you're not even, obviously you have to be logged in, but if you're not even on Twitter, you can like it from here by clicking that heart. You can also like the Facebook post here too. So you'll notice at the bottom, you can do this while you're watching. Just click on that like, click on that thumbs up. Like I said, that tells me, in addition to the like on YouTube, that tells me you want me to keep doing these videos. Brandon will be back tomorrow. You want him to do a video tomorrow? Let us know by continuing to like and retweeting these tweets and giving us a thumbs up and commenting. You can see you can also comment down here on the blog. Of course, you have to subscribe first, but you can comment on any questions that you have from today's video or anything that stands out to you on the blog as well. And to get to this, again, it will probably be hyperlinked to you, but it's just marketscholars.com/blog. That will get you to our blog where you can see all of our posts there. Okay, if we take a look at the different asset classes, you can see how we had diverged away and small caps led us up, and crude oil kind of lagged behind during that bullish run. Well, now you notice that we're converging again, and what was winning is pulling back, and what was losing actually is coming up. You can see from this point right about here, crude oil hit the low point, and small cap stocks kind of hit their high point. You can see that crude oil is actually up 3%. Small cap stocks, large cap stocks down 3.25%. You can see that nice little bounce that they had at the end of the close. So basically, it was a reversal. This has been a reversal. Now today's move, like I said on the S&P, was a little bit of a breakout move. You can see they hit that gold and bonds hit their peak as a safe haven before stocks hit their bottom. So a sign that, a little bit too far of a momentum play, and the stocks in fact, small cap stocks actually pulled back above that peak. So you can see now why we bounced up so hard into the afternoon, because we didn't continue to go up on these other asset classes. It wasn't a complete risk off move all day long. Remember, the volume wasn't really heavy either. And then, of course, crude oil didn't drop. And by the end of the day, crude oil actually finished. It dropped early, but actually finished with the best performance outside of gold out of all the major asset classes. You can also see the dollar dropped, and that's usually a safe haven. It outpaced stocks, but you can see it didn't outpace long-term bonds. Bonds finished with a slightly better gain. So, not the most risk off, and even high yield almost beat bonds by the end of the day. Bonds finishing with a decline themselves. When you look at the calendar, not a whole lot on the calendar. Of course, it was all about Facebook today, and Facebook and their data breach with partners that have been using Facebook's data, and how culpable should these social media companies be when their data is being used inappropriately. And so a lot of that really put some pressure on the FANG stocks, mainly because of how bullish they've been. Not really changing any significant long-term trends in the process yet, at least. From a calendar perspective, the main thing that's due this week is that rate hike expectation. You can see it's the meeting, the announcement's supposed to come out Wednesday. They're widely expected to raise rates, but that's not the important thing. The important thing is, with the dot plots that come out and the press conference, the first press conference for the new Fed chair after a meeting, what's going to happen to the June rate hike odds. And already you're getting about a 75% chance that we'll get a rate hike in June. Is that going to jump up? Is it going to pull back significantly? Rate hikes initially in the short term can be some headwinds for stocks, but on the other side of things, the growth that the growth in the economy and prices that precipitates these rate hikes will actually bring stocks up. Remember, stocks earnings have had one of their best quarters they've had in years this past quarter. So, there's a lot of other factors that influence stock prices, including that dollar. But, the fact that we are getting a rate hike, while it might produce a little bit of a headwind in the short term, actually stocks usually go up during rate hike cycles because of why we're getting the rate hikes. Until, of course, you push up those rates so high that your yield curve, if you were to go take a look at the yield curve, if we push up rates too high too fast on the short end and the long end isn't able to keep up, it's not going to keep up nearly as fast. It doesn't move as fast as the short end. But if this is the 10-year and the 90-day, if we just take a look at the 30-year and the 5-year, if this continues to push down toward and get too flat, now if it's dropping, that's not a bad thing in and of itself. It's when it's flat. There's when we get to zero, that's when it's flat. So you can see, we were dropping the stock market during this time. The rate hikes cycle was mid 2004 to mid 2006. That was the rate hike cycle, and eventually it did get flat by the beginning of 2006. But you notice while this curve, the yield curve, started to jump up, it wasn't until when things started to get more volatile. See that in February of 2007, things started to get more volatile, but the trend of the market didn't peak until October of 2007 right here. That's when the market peaked, and of course we started a recession through the middle of 2008, and the stock market ended up bottoming out in March of 2009. So, again, by the time we were at this point in the rate, we still had another year of rate hikes, and that was like at every single meeting. We're just getting them every quarter. That was at every single meeting by the time we eventually got to a flat yield curve that in this particular case preempted the peak in the stock market, or forecasted the peak in the stock market almost 2 years later, about a year and a quarter after the very, very last rate hike. So that kind of gives us some perspective that things are not all that dooming. The rate hikes that we are getting are not causing a recession or predicting a recession anytime soon based on what we've seen in the past. From a sector perspective, not surprising to see technology really pushing us down. Again, led mainly by Facebook, but not only Facebook, a lot of areas. Semiconductors, a lot of areas really fell today in the technology sector. When you look at the Market Watch tab here, you can see Internet Software and Services. That's where your Facebook is. You can also see semiconductor equipment really struggling as well. Those were your biggest losers in that technology area. There's your home entertainment software, industry systems software, communications equipment, technology hardware, all dropping to the downside. To the upside, the best performers today, you can see the aerospace and defense, gold, oil, coal and consumables, aluminum. So your basic material, there's a lot of your REITs as well, but basic materials and energy stocks doing pretty well today. And then you can see some of your industrials, road and rail, railroads, kind of small loss of it outpacing the broad market as a whole. When you take a look at this chart, you can see that here, that we started off with utilities and staples doing well, real estate holding up some outperformance, financials holding up some outperformance with the rise in yields, industrials also doing pretty well. In fact, by the end of the day, industrials had some of the best outperformance, along with these safe haven areas and financials. You can see materials, energy stocks lagging, and then, of course, technology all lagging as well. Remember, the weak dollar, you would think that would push up this materials and energy areas, but it didn't quite do that. And then off of the low point here, so here's where this S&P hit its low. You can see technology led the rebound, and industrials led that rebound, and materials, and healthcare was there too, and consumer discretionary is up there, and then there's your safe havens lagging, but also still rising. So, you know, we've had a pullback, and we've been continuing to pull back from these highs, the stock market highs all the way to the low today. Technology materials kind of leading that 3.5% decline during this 5-6 day pullback that we've had. You can see utilities finishing this decline with a small gain, and real estate continuing to show some outperformance. Those are those two really struggling areas that during the increase haven't been doing so well. During the strong bull market we've been having for the last so many months, had not been doing very well at all. And again, like I said, technology dropping as much as it did today, not because of, there's some news that came out that impacted the sector, but it was also because it had been outperforming. It had almost twice the returns as the broad market did in this from this period of time, 6-month period of time, including consumer discretionary. So all your FANG stocks in there, when they've got such strong gains, they're going to give up those. It's like, again, walking a tightrope, very, very high tightrope. At some point in time, when there's any kind of wind, crosswind, there's going to be a little bit farther of a fall because of how much outperformance they have to give back. Whereas on the other end, you can see why utilities and real estate are kind of poised, and consumer staples too, for that matter, are kind of poised for some potential outperformance in the near future. Especially if we get that higher volatility in the springtime, you'd expect, if not show some gains, these areas to at least outperform. Okay, today's trade idea, I wanted to take a look at Facebook because it's offering a very intriguing technical pattern. First of all, you can see we got 3 red arrows. Big drop, obviously. You can see there's some resistance around 170, kind of the midpoint of that sideways range we were in, and then multiple attempts to come down and get below 170 and not able to break it. And all these other times, look at these spikes in volume, where once you get that spike in volume, it doesn't really go anywhere again after that. And this is the biggest spike in volume that we've had, with some support at 170. And you can see trading in the after hours right around that 170. So it's kind of at this inflection point. You can also see too, getting outside of the Bollinger Band, every time it's kind of gotten outside of that Bollinger Band by a significant amount, it can't quite do anything else. Especially after, not really here, we kind of pushed a little bit up through it, and then we started to push as we were coming off of a low Bollinger Bandwidth. All the other times, it was a big move to the downside after after kind of being on the other side of the moving average, the exponential moving average, and breaking down hard. And you can see breaking down hard from the upper Bollinger Band here, breaking down hard without really kind of pushing that lower band lower. And here again, from the upper side, breaking down hard. So there's been past precedent that when it does this, it's kind of hard to get going. And all the other times, we kind of rally off of those. Whatever lows, whatever moves cause that, we kind of rally off of that. So are we going to do that again? Well, if we are, then one way you can do that with volatility as high as it is right now, implied volatility, is to sell the puts. Sell that 170 put, buy the 165 put. You can see your credit's really high right now. You can do that for the 32. You can go out to the 39, to the weekly, and do the same thing. Either one of these, you can look for, just selling and buying. And again, the credit that you want, these are pretty wide spreads, but it's a relatively expensive stock. So you have to kind of fiddle around to see what kind of credit you're going to get. What you need is at least $1.20. That's the credit that we need. That's what gives you the 30% return on risk. So if we were to analyze that trade and throw this on here, you can see that right now you kind of need it to move up a little bit. In fact, according to this, you need it to move up a couple more bucks before you get into it. Kind of make sure that we're going to bounce off of this low point before you finally get filled in at 170. And then now you've obviously got some support there. But if we break through that 170, now we're looking at more of a longer term, buy this put opportunity and see how bearish this can be, because there's opportunity now because you're breaking through support for it to make a run. And you can see from a long-term basis, we've been converging. See how that MACD has been converging. We're getting a lot of shadow, a lot of arrows. If we were to break down below this, you would expect it to hold, get below the 200-day moving average and hold. And again, 170 being the key mark for that. So there would be opportunity from a long-term basis. You can see there's nothing really resist support-wise holding it up until you get to that maybe 150 area where there's a lot of sideways action, and especially this old high point that you have at 130. So there's going to be opportunity for a put if we continue. If we break the 170 to the downside, if we hold it, then we can look for selling the put and taking advantage of the higher volatility. So it's a great opportunity, a great chart here, the inflection point. Now, based on what we've seen, you would expect it to hold that 170. And the nice thing is about that setup, if you use a stop limit order here, let's edit this. If you use a stop limit order here, stop limit, then now it won't fill you in on that price, because you need that price to get down to where you want it to be. Using a stop limit order would make sure that we are going to hold this 170 and bounce before you end up selling that put vertical. Otherwise, tomorrow morning, if we break through 170, then you have the opportunity instead to look for more of a longer term and go out a little bit longer time frame to avoid the time decay, but buy the at the money, depending upon what it would be, depending on how much we break your buy, you buy the at the money put, and then ride that swing trade, ride that support breakout until it finds, in this case, probably some support down here at the 150 area. So that does it for tonight. Remember, to summarize, the posture for the S&P 500 starting to turn weekly bearish, but for the NASDAQ and the Russell 2000, they still show strong bullish postures, and all the major indexes are still showing the possibility of higher near-term lows to be formed. In fact, short-term sentiment for pretty much most of these all improved because of the long lower shadows that we're seeing on the indexes with the rally off of the low point at the end of the day. So if that continues into tomorrow, then that short-term sentiment can improve its way on up to a new bullish posture, a higher low point, a higher near-term low point. Otherwise, if we hold this kind of breakdown that we see on the S&P 500 and continue to push down, especially if a stock like Facebook in our trade idea breaks its support level, then we could be in for more of a bearish posture here for a while and trade in the lower half of that 4-week range and then start testing that 4-week low point again. So as always, thanks again for watching. Have a great evening, everybody. Remember to like, comment, and subscribe on the YouTube video down below. Follow me on Twitter for more content. Join the Market Outlook community on Facebook. Remember to like us, like the video. Let us know if you want us to keep doing these with a simple one click on YouTube or on the tweet, tonight's Market Outlook tweet, or in our Facebook group. So that said, thanks again. We'll see you all tomorrow.